Do you know what it really means to invest? We're about to take a look at two different hedge funds that are operating right now, Hedge Fund A and Hedge Fund B, to understand a little bit more about what investing really means. And if you want to know the stocks I'm talking about, stick around to the end. So what two stocks are we looking at right now? Stock A and Stock B. Stock A primarily focuses on what they call disruptive industries. They look at innovations that they believe or that they think will change the world and make it a completely different place. While Stock B is going to focus more on undervalued companies. So these two stocks are real companies with billions of dollars in hedge fund value. So what do these two different stocks invest in and how do they work? Stock A invests in crypto. It's kind of a little bit more on the speculative side of investing. Stock B, on the other hand, looks at companies that have a large market cap and they're already established. Stock B is going to be searching for companies that are undervalued within this category. First clue on Stock B, they actually own a big chunk of Coca-Cola. With these drastically different trading styles, let's just take a quick look at the graph of these two stocks as they traded over time, starting in 2016. They both go back a little bit further than that, but it's a good starting point. From 2015 to 2016, both of these stocks have went down. As you can see, both of these stocks have moved in the same direction. Going into 2017, we see a quick rebound with Stock B actually beating out Stock A, and out of nowhere, Stock A just climbs like crazy. So Stock A went from about 3% return in 2017 all the way up to about 100% return in 1 year. At the same time, looking at Stock A still went up, but not at the same amount. So Stock A is sitting around 42% return. We're now reaching 2019, and in 2018 to 2019, both of these stocks have kind of hit their max point, but Stock A has actually went up an additional 25%, whereas Stock B has actually stagnated, went down, and then picked back up just a little bit at the end of 2019. In 2020, Stock A has now risen up to 150% return over these past years. So this is starting in 2015. It's now up 150%. Stock B has performed extremely well in that amount of time period. It is up 50%, not as quite as high as Stock A, but as you're going to see, things are about to change. So here we are. This is a little bit crazy, and you're going to see what we're talking about. Stock A, the one that is way more speculative, investing in disruptive industries, cryptocurrencies, everything that you'd think of as, wow, that's going to go and generate some crazy return. We're sitting at about 400% return in 2021. It was a jump up from a 200% return, while at the same time, you can't even really tell about where Stock B is, but it's in around the 60% range. Now, this is where it shifts. This is one of the key things I want to highlight in this whole video. The whole time, while Stock A and Stock B have been fighting, we've seen Stock A go from the underdog to take off. All of a sudden, they exploded. And now we're reaching 2022. During 2022, we've seen increased inflation rates, a lot of economic distress, war with different countries, and the economy is not as hot as it was. So what this means is when the economy slows down, people start to invest in things that are a little less speculative. So at the end of this graph, what's happened, we've seen that Stock A had this huge bull run. They've skyrocketed up, and all of a sudden they hit this plateau of maximum value and they've tanked. They haven't recovered from there. Stock B, on the other hand, has continuously grown at a stable rate. And at the end of the day in 2023, that's the beginning of this year, Stock B is actually trading higher than Stock A. So what happened? Both companies moved in the same way. As you've seen with the graph, when the companies went down, both of them went down. When the companies went up, typically both of them went up. What this has to do with is market momentum. The reason company A had a higher fluctuation is because it had more risk. And in the end, it came back to bite them. So let's take a look at the value of Stock B. Stock B has stakes in everything that you use on a day-to-day basis. It's going to be insurance, it's going to be hospitals, it's going to be food, it's going to be any service that you're using on a day-to-day that you're required to have. These services, they're not going to go away. If you start having less money, are you going to spend your money on food or are you going to spend your money on crypto coins? This is why speculative investments during recession, they just don't hold. This is the main reason why Stock A went from 600% return back down to zero overnight. And now, big thing I want to talk about looking at this graph, you really got to remember it's not about the short-term gain. So statistically, for these two companies, Stock A, over its entire history of its growth, has returned a 6.89% return. Stock B, over its entire life of growth, has returned a 12.36% return. The average return if you were to invest in the S&P 500 is 10%, okay? You would have been better not investing in stock A and just investing in the stock market, but if you were to invest in stock B, you would have actually beat that return. But I hear everybody say, oh yeah, I'm gonna ride the wave, you know how it goes. So everyone thinks that they're gonna buy in 2020 and they're gonna sell at 2021, and they're not gonna be the one that loses their money. But what ultimately ends up happening is the people that have rode it from 2020 to 2021, that's 50% of people. The other 50% of people have lost their money, all of it, that 50%, from 2021 to 2023. Don't be on that other side of it. If you were to just invest in stock B, everyone who invested in stock B saw a return. Don't become a 50-50. So, what are these two stocks? Stock B is Berkshire Hathaway. Berkshire Hathaway is a stock that's been around for 40 years. It's a hedge fund. Ever since its creation, it has went up 18,451%. 18,451%. On the other hand, stock A is ARK. Stock A came out around 2014 when all the hype came out around all these speculative and cryptocurrencies and all this other stuff. And if you were to invest in ARK, 107% return. Now, is that a bad return? No. But if you were to just invest in the S&P 500, you'd have made 506% return. So that's the difference between fundamentals and speculation. Now, this is all great, but if you don't understand the fundamentals of basic budgeting, you're never going to have that money to invest anyways. So go ahead and check out this video where we start to get into the fundamental basics of budgeting and everything you need to know in under 3 minutes.